Hello? Good morning, friends. Rashmisha here. I hope everyone is fine and now getting to the used to the new life. So this is my fourth webinar in this coronavirus series, uh, and today I'm going to talk about diversification in the global world. So before I start my talk, a few caveats like every time that this webinar is for investors residing in India and Indian residents. Uh, so this is not for people living in North America or in other countries. This is for people living in India and Indian residents uh, only. Okay, so let's start. Now, 2020, so is a year none of us are ever going to forget in a lifetime. There are very few years in a lifetime which we never forget. One is our birth year, the one is our graduation year, one is our marriage year, and this 2020 is the year which we are never going to forget when the world changed. So it has changed the world and it is going to change all of us. So the impact of coronavirus has making all of us think, how do we manage our career, how we manage our risk, and how we manage our future. So diversification plays a very important role, and we have to change our thinking about investments in lieu of coronavirus if we have not changed it so far. Now, so let me explain it much more in details. So what is diversification? So this, okay, again I'm saying globalization. The global economy has changed in last 3 months. Now going forward, the globalization is going to be more or less? My answer is globalization is going to be even more than what it was before this coronavirus came. And we are going to be more dependent on technology than we were before. So one thing which all the governments in the world realize, that if technology was not there, the lockdown which we had in 2000 last 2 months was not possible. None of the governments could have been control their population the way that technology helped them to control that population, and they saved a lot of lives. So the importance of technology, every business, every government, every citizen has understood this, and post this coronavirus, the technology is going to play even more bigger role. So national boundaries won't matter any longer. So we need to understand that. So this is one of the core premise of my today's talk. So how do we understand? How do we make use of it? By diversification of our portfolio. What do we mean by diversification? But randomly choosing different investments is not a diversification. Diversification means you choose your investments in such a way that all investments don't go in the same direction. So if one is going up, the other can go down. Other will go on sideways. So that is diversification. Just by investing in random products, and they are different products, is not a true diversification. A true diversification means all the investments are behaving in a different manner. So we need to understand that. But most of the people understand that, okay, I think diversification means I'm buying different products, different investments. I have multiple advisors. That is not diversification. How this different investments behave. Now, if all your investments went down in this coronavirus, then there is no diversification. Now, diversification, if the investments gave different kinds of returns with a wide margin during this coronavirus period, then yes, then you are very well diversified. So that is the way you have to look at it. So I'm going to talk about that. Now, let me ask you a different thing, correct? Why do we send our kids to English school? My grandfather went to Gujarati school. My father went to Gujarati school, but they had sent me to English medium schools. My education was in English medium school. Why? Because they saw that the local language, local mother learning in local language was good, but their exposure was only to the local economy. They wanted me to have my career prospects globally. So English is the language which allows you to have a global prospects, professional. So that's why we send all our kids to English. Same way your investments, why you want to invest only in the local market? Because then you're restricting the prospects of your growth of your money. Shouldn't your money be also be treated like the way you treat your students for education? It should go global. So there are in companies which work locally, companies which work on internationally, multinational companies, and companies which work globally. So we should have all those three in our portfolios. So that is what I call diversification. But most of the people have concepts of diversification that, okay, I invest in small cap, mid cap, large cap, then I invest in a hybrid fund, balanced fund, then I invest in a PMS, and I invest in insurance policy, and I keep money in bank deposits, so I'm diversified. No, they are not diversified, because all your investments are in rupee, all your investments in the same economy. So if the economy is going to collapse, even your fixed deposits are going to collapse, even your credit funds are going to collapse. Yeah. So you're not diversified. But if your investments are in different currencies, different countries, they are diversified. That's what I mean by diversification. So same way, you need to invest globally to get a true diversification. Now, I'm going to talk about this for next 15-20 minutes, and then I want you to ask me questions. Feel free to ask me questions on text, and I'll answer them in the order which they come. Also, I want you to, if you like this today's event, I would like you to subscribe to our channel, which I'll show you in the end of this presentation how to do that. But feel free to ask your question. You can start posting your questions now, but I'll answer once I finish my present talk in 15-20 minutes. Now, coming back to your current investments. Your current investments are 100% in India. Now, let's analyze that, correct? India is a growth story, yes, we all know. It's an emerging market. If India were a stock market, how would it be? It is one stock. If India is considered as one stock, how does an investor look at that stock? It's considered as a mid-cap stock. Now, what does it mean, mid-cap stock? A mid-cap stock is a stock which is going to grow, but it has limited resources, capital is scarce, and it's not fully mature management. So if external shocks come to the economy, that stock may collapse. Same way in the Indian economy is an emerging economy, and if external events happen, like coronavirus happen, it gets impacted drastically. So that's why it's considered as a mid-cap stock. Now, a large cap stock is a stock which also gets impacted when some virus thing happens, but it rebounds. It rebounds. The management has gone through different cycles, has gone through different. So if you consider US, Japan, and they are large cap stocks, and they have much more bandwidth to rebound and take this kind of losses like what. But India has a limited capacity. So that's what I mean to say that's why you need to globalize. That's one of the reasons. We are living in a global world with no boundaries, correct? So this is the way we need to analyze your portfolio. Now, let's give you some more insights. Benefits of investing in America, correct? I'm talking about US today, one of the global destinations. Now, do you know how much currency, US dollar is one of the strongest currencies in the world. Now, during this coronavirus, last week, $1.5 trillion of cash was outside America. So hard cash, which people were holding currency notes outside America, of which 50% cash was with Russians. So in Russia economy, they virtually trade in dollars than ruble. So dollar is the currency in Russia. So in many countries, you see, when this coronavirus started happening, people went and started buying dollars in a big way. Now, India was fortunate; the Indian currency didn't crash that much. It did went down by 6-7% from 70 rupees a dollar to 75, 76 it is now. But some currencies like Brazil, it collapsed by 25 to 30%. So during the times of crisis, the global flow of money goes to the strongest currency. So there's only one basic reason you need to invest in a US economy. Then second, US has the best and most innovative companies in the world, the best brands in the world, and they have the largest. So you read papers, news in the papers in India that India got $10 billion of foreign direct investments, and total FDIs India get in a year is about $50 billion. You know how much US gets FDI every year? More than $500 billion FDI investments comes to US. It's such a big economy. So even big companies like Honda, Toyota, all those big companies, they have built plants in America. Mercedes-Benz. So that is an FDI investment. Mercedes is from Germany, Honda is from Japan. So all these big companies, Samsung, and they have to come to US and build plants here, and they have to bring FDI investments. And today, if you think US is number one in technology, I was talking to one of my friends today, and he says US is 20 times ahead in biotech. In biotech and health, no country in the world is even close to, in medical field, to US in research and innovation. And we'll see that impact in next 2-3 years because of this coronavirus. Now they're going to go after this coronavirus and health. You will see the kind of innovation and research happen in this field. That's why you need to invest in US. Also, US has 1,000 ADRs. ADRs means American Depository Receipts. So companies like HDFC, Infosys, they're all listed in US. So there are 1,000 companies from different countries in the world. Their stocks are listed in US. So most of the FFIs, they don't have to come to India, convert into rupee. They invest directly on New York Stock Exchange by taking these ADRs. So US financial stock market is one of the strongest market in the world. So that's another advantage of diversifying your portfolio. Now I'll share some more insight. Now, if you see in India, 99.9% of Indians invest in large cap, mid cap, and small cap. And only 0.1%, that is 0.10%, 0.01, that's less than 1/10%, invest in India and US, isn't it? And nobody is investing outside US. No one has hardly any portfolio in Japan, in Germany. Those kind of investments are very small. Now, if you see even the profile of Indian investors, HNI clients mostly invest in large cap. Middle class families invest more in mid cap than large cap. And retail investors, mostly investors who are beginners, who want to make quick money and their learning curve, they all go to small cap because they think small cap is going to be, every company is going to be next Infosys. And that's how they invest in that way, and they burn their fingers. So this is the category of profile of Indian investors, which is going to drastically change in next coming years. Now I'll share this more data country-wise. If you take the United States, so there is a thumb rule that every person should invest 60% in the home country. So if you, fundamentals of global investing is every person should invest 60% of amount in their home country and 40% outside the home country. Now in America, Americans, the US citizens, they invest 80% in America and 20% outside America. Now the US financial market is 41% of the global stock market. So this 80% goes in 40% of the world stock market, and the rest 20% goes in the balance 60%. Canadians, they invest 60% in the Canadian stock market, and the rest, mostly majority of that, go in the US market. Now Canada has only the market cap of Canada is only 3% to the world market cap. US is 41. Australians, they invest 67% in Australia, 33% outside Australia, and that's only 2% of the world market cap. Japanese invest only 55 in Japan, 45% is outside Japan, and Japan is for 8% of the world stock market. So Japanese stock market is 2.5 times bigger than Indian stock market, but still they invest only 55 in Japanese stock, whereas Indians invest 99.8%, and our stock market is only 3% world share. So, and we are ignoring the 97% of the world stock market. And how can we call this diversification? And that within that 3% we invest in small cap, mid cap, and large cap. That's not true diversification. So when this kind of global crisis comes, all the portfolios perform in the same direction, and that's unfortunate. Now, so what happens if you're not diversified? If your diversification is not true, what happens? Then the fear, the emotions takes control of your investment decisions. So what happens is when you stick to one country and when the country takes a beating, first you're in denial mode. No, nothing is going to happen. Then you get anger, then withdrawal. And at the bottom, like in March 15, then there was a bottom. Many people panicked and sold their investments at the bottom, correct? And then market starts recovering, you get angry, then denial. And then again, when markets are 25% up, they start investing. And this is a typical behavior of an investor who watches. This is nothing new. I've been in this field for 40 years. I give the same investments to all my clients, but some clients make a lot of money, some clients make very less money, and why? Because of their personality, because of the way they digest information and they will react to news and media. So emotions take charge when you are not properly diversified. So one of the key reasons for diversification is that you need to have a balanced approach. Now I'll show you some real data. The other thing, what happens is, I'm going to show a case study also in the later part of this presentation, how the portfolios perform. There's a real portfolio I'm going to show you how it performed during this crisis. So what happens as the different asset class perform in different cycles. So Indian stocks, if let's say if Indian stocks are going down, the US stocks are going up. Japanese stocks under recovery, global. So they perform differently in different cycles. So when you have this kind of portfolio, what happens is at any stage when you want some money to withdraw from your investments, you have some funds where you can withdraw, some funds where you can add money. So that's the advantage of a truly diversified portfolio. But unfortunately, we invest 99.9% only in Indian economy, and that's not good for Indian economy. And many people think that nationalism is. No, that's not nationalism. If you're healthy, the country is healthy. Like they say, if mother is healthy, the baby is healthy. So mother needs to take care of herself first and then the baby. Same way in investments, if you're healthy as an Indian citizen, your country is healthy. And you should invest globally with no emotions. That's the reason we should do that. Now ask yourself, then why you invest globally, correct? So let me ask you, during our grandfather's time, in 1950s and 60s, we used to buy products from Hindustan Lever and Colgate. Our parents used to do that. We are going to do that. Your kids are going to buy Hindustan Lever products. And the next grandkids also going to buy after 20 years Hindustan Lever. So those who invested in those kind of companies made a phenomenal return. Same way, ask yourself, are these companies, Microsoft, Google, Apple, going to last 10 years, 20 years down the line? Yes, they are going to last. Now, but if you invest in some infrastructure companies, like, or you go by value investing concept is dead today. Because see what happened to all your PSU banks. How many of us can tell you, say after 20 years, this PSU banks will exist, or 10 years? We don't see any visibility. We don't know even Air India is going to exist after, correct? Government is trying to sell India for a long time. So you need to invest in companies where visibility is there for next 15 years, 20 years, and those kind of companies are there globally more than in India. So that's another reason for diversification. Now I'll show you how you build an all-weather portfolio, correct? So you go with national brands like companies like HDFC, Asian Paints, Infosys, Bajaj. So these are national brands. Then you go for international brands which are available in India, Hindustan Lever, Nestle, Cognizant, and then you for global brands, Microsoft, Google, Amazon. So all these companies' products we are using in India today, correct? And you ask now, you when you invest in this kind of baskets of investments, your portfolio is truly diversified, truly diversified. Now, again, I'm saying you don't have to buy stocks of these companies. You can buy mutual funds. You can buy a basket of mutual funds. There are different ways of investing in these companies, and but you need to have this kind of globally diversified portfolio. Now, if you have portfolio only on this type, then you national brands, and then what you will do is you will add some more small and mid cap. Your portfolio will suffer when some national crisis happens. That's what I'm saying. You need to have a balanced approach. Then let me share some more other insight. Difference between a diversified and a non-diversified portfolio. What happens is, let's say you took a momentum stocks. You watch CNBC and you watch Economic Times. Most of you nowadays are watching, sitting at home and reading newspapers and following televisions and CNBC money control will say buy this stock and you buy those stocks. So you're buying momentum stocks. So all the momentum stocks will go up in a one way, but you'll get stuck there. And in short term, you may benefit by momentum stocks, but in long term, you will suffer because all your investments will go in one direction if something happens. But if you're a globally diversified portfolio, they may not give you immediate returns, but they'll give you steady growth. But you see the long term how it goes up, and non-diversified portfolio always takes you long-term negative returns. Long-term negative returns, a diversified portfolio, long-term very good steady returns. Short-term, a concentrated portfolio will give you higher returns, but the risk is also very high. And that's what I'm trying to make here. We need to have a very total good clarity on doing this. Now, diversify your portfolio globally. So you invest in local growth, global growth, innovation. Now, how many of you, when you analyze your investments in your portfolio, how many innovative companies you have? How many innovations you have? You need to identify. So the best innovation companies are in US and Japan, outside India. So so there are 5 economies in the world who are innovating the most. Number 1 is US, and number 2 is China, number 3 is Japan, number 4 is India. Now, India is in the top 5 countries in the world, and number 5th is Germany. So if you take these 5 economies, correct, leave aside China, because China, the transparency is not there. There are a lot of global issues are there. So I would at least focus on the top 3 and top 4, correct? So if you invest in those kind of economies, your portfolio will give you a very good steady return. Now, your next question is, how do I do those investments? There are different routes for different kinds of investors. So you can invest through mutual funds. In India, you can invest through mutual funds abroad. You can invest in ETFs abroad. You can buy stocks abroad. But that kind of thing depends on what kind of level of maturity you have. So the most important thing you need to understand. So I'm going to show you a globally diversified portfolio. So this is a portfolio which we started investing in January 9, 2020. This was before the coronavirus happened, and this is a pretty decent sized portfolio, about 1 crore 50 lakhs. We started invested in last 4-5 months, and most of the investments came before the coronavirus happened. See what happened. So diversification is the core strategy we had. Then allocation is the second process we had, and the timing. Now in our case, initially the timing went wrong, correct? But these two were a positive. Now, so what happened? Our Indian banking funds gave us negative 70% return. Credit risk fund gave negative 1% return. Arbitrage fund gave 1% return, positive. Large cap gave minus 1% return. Mid cap minus 3. Healthcare gave us, pharma gave us 26% positive return. Technology gave 5%. US diversified portfolio gave us 6%, and US technology gave us 15%. Now, if you see, even in this market, we got an 11% return. Now, again, I'm saying, This return would again change in spite of having the same portfolio if how much allocations we do. Suppose it was more heavy in pharma and technology, the return could have been even 40%. But our allocation there was much less than it was 10-15% allocation, and there was a 10% allocation in other baskets. So it depends on how you allocate. So the timing, so it's not a simple thing to invest. Just by investing you don't get returns. You need to have a proper understanding of a diversification. Then you need to understand what kind of allocation you want to give, and then you manage the timing. So timing and all this three requires very sound rational judgment, no emotional judgment. Most of the people say no, हे खाली चल रहा है तो हमारा इन्वेस्ट नहीं करायचं, ये जो वर चल रहा है. So if you are chasing investments which are going up and you are not investing what is going down, you are going to get hit very badly. Now, in this portfolio, what we got, the return of 11%, 1 crore was invested before 15th Feb. So it took a hit, correct? It took a hit, but we invested additional 50 lakhs between March 15 and March 30th, when the markets were going down, and we took the advantage. So this is a way to do investment. So three things matters: diversification, allocation, and timing. And so this is a complete process you have to follow. So all three together is process. Now to understand this, you have to be very clear. And here's where most of the investors in India make mistakes. They watch TV, they read papers, and they think investment is so easy. It's like that, you buy a cooking book, you have never cooked any time before, open that manual and start cooking your lunch on your own. And on the very first time, imagine what kind of lunch you have. So same way is investing. It requires a lot of expertise and a process. Now, I'm going to summarize why did the market go up in April. So since I'm doing this weekly webinars, I want to just give you an update what happened in last 1 month. So in last 1 month, the US government pumped almost $10 trillion in the market. So what was the US government theory? That, okay, my total GDP is $22 trillion. My economy got hit by $3-4 trillion. And if I pump in $10 trillion, I'll protect all those companies and institutions from going bankrupt, and I can bounce back after 6 months or 1 year when the coronavirus solution we have found. And that's how they pumped, and they're trying to protect the big institutions and corporations. So US has done that, the Europeans have done that. India has not done that much, correct? India is lagging behind, but I'm sure the government will come. In India, the government is not business friendly compared to the US and the European or the Japanese. Over a period of next 4-5 years, I hope India will change. But that's another reason why you need to diversify globally. So also April 2000, and now Indian markets went up because the US market went up. Indian markets didn't go up because the government of India did something good. Indian markets went up because the US government didn't. And the other big advantage Indian market got is the oil. Oil saved, from $50 it came down to $12 or $15, correct? So for every $1 price reduction in oil, India saves $1 billion a month. $1 billion a month. So imagine the kind of, India got a windfall gain of 60, 70 or $100 billion just because of the crashing of the oil prices. So I'm sure that will help the Indian government to pump the money in the economy and help the economy to revive. Now, coming back, what's going to happen in next few months? In next few months, the markets are going to not go up and down, because now as we are coming, now the world is trying to figure it out. After getting a heart attack, when you start to recoup, you just can't start running the very next day, correct? So you get tired very fast, you felt dizziness, and you feel like going to sleep again. Same thing happens to the economy. The economy is not going to run away and come back to normal within 15 days or 2 months. It's going to have a lot of doubts that, and so the markets are going to be volatile, and this is the way, this is going to be a very good opportunity for you in next 2 or 3 months time. So in a down day, invest; in a up day, don't invest, and build your portfolio in a global markets that way. But you need to have a very clear thinking. Now, so what went in up in April? So everything didn't go up in April. So what went up in April? So three sectors which got least affected by coronavirus. One was consumer discretionaries, day-to-day items, branded goods like Nestle, Hindustan Lever in America, Amazon, Walmart, Target, those kind of stuff. Then healthcare, hospitals, medicines, and the technology. So these were the three sectors which didn't shut down during the coronavirus, and they went sharply up. And some of the stocks went even beyond February 15 prices. So that happened, correct? But the other old economy stocks like oil stocks, automobile stocks, they really didn't perform that much in month of. Now those value investing is going to give still some pain in the coming 6 months. Don't fall in that trap. Stick to quality and build a, understand, work with a professional, find out which are the sectors which are going to grow, and invest in those sectors and in those economies and build your portfolio. That's what the advice I would give. Now, managing investment does not happen without this three pillars. You should not. The other thing which I've noticed, most of the people invest after seeing the price of the investments stock, and they justify that price and then take the investment decision. You should never do that. You should invest without, irrespective of the price. First build the vision. Okay, I want this stocks, this companies for next 20 years. I don't care what price it is, and I don't want to invest in this stock even if I get it free. So I wouldn't invest in value stocks, PSU banks, even if I get free. I would invest in Amazon, Google, Hindustan Lever, no matter what the price is. So that should be the strategy you should follow. So first you need to build a vision, then follow a strategy, and once you have this to clear, build a process of how to get your vision and strategy in place. And these three things combined will give you a return. Just random investing, picking up information from 10 different sources and using your gut level and buying any stocks, what is the tip of the day, you're not going to make money, because that way you're always going to justify what price you see on the screen or what you price you, and based on that, so you're going to invest for short term. Don't do that. The portfolios which people think really long term, they make money, and that's with this I'll end my today's presentation. Now let me tell you, next week I'm going to talk in more details what is the difference between strategy and timing. So how timing and strategy both impacts your portfolio, and I'll give you true real life examples and case studies. I'm going to present that, which will show you. And also you should do one thing in your lifetime, whatever mistakes we have done. See, we all like to talk what good things we did in our life, but we do a lot of mistakes also in our life. The person who talks about his mistakes first, he improves, correct? And he learns from his mistakes. And you analyze those mistakes, you will come to know that in most of the cases you went for timing and you didn't focus on strategy, and that's why you made losses. So if you focus on strategy, so I'm going to show that next week, and I'm going to share that with you with real life examples. The other thing which I want to end my today's presentation is, if you like this webinar, I would like you to go and subscribe to our channel. I would and click on this bell. Click on this bell. So the moment you click that, it becomes, you'll get automatic notifications whenever we do webinars. And I'm planning to, as Simplicity, we are planning to do a lot of webinars from which are educative. We will never do webinars to sell you any products or sell you any investments or give you any tips what is going in the market. That's not how we work. We work for long term, and we focus on vision and strategy and creating wealth. Wealth never gets, see, Taj Mahal never got built in one day. It required a vision, correct? So you see, that's the difference between town planning in US and town planning in India, correct? We just build the houses the way we want. We don't do a proper town planning. Same way we build our portfolios. The way towns are built in overseas, the same they build their portfolios the same way. Same thing you should do in India. Let's change. Let's use this 2020 as a year where we changed our life and thinking. Thank you very much for your time, and I'll answer your questions. Okay, so the first question I get is, do you suggest to invest in PMS? My answer is straightforward, no. PMS is a very complex product. It's a high return, high risk product, and it doesn't give you a diversification. It's PMS as a product is not sold in America. PMS is a product only people having 20 million, 30 million dollars, that kind of. It's 25 lakhs, 50 lakhs PMS products are sold. No, I wouldn't do that. It has a lot of complications, and we are against PMS. I was the first guy in India to get a PMS license in 1992. Uday Kotak was second, and I ran that PMS company for 4-5 years, and I said, no, this is not a good product, and I shut down, and I took heavy losses, and I had to close down that. And since that day, I'm against PMS. It's very difficult. It's very concentrated, high risk product. Then second question is global entry of digital one versus leadership of dollar. Okay, dollar versus now, most Chinese economy lacks trust. Okay, if you go in any country, you go in Europe, you go to America, you go to Australia, you go to India, how many of you trust the Chinese, correct? And they don't have transparent accounting system. They don't have, so no, I would never. Yuan is never going to be a global currency, at least during a lifetime, unless the China as an economy becomes very transparent. And it's not so easy to become transparent. It takes years and years and years of sacrifice to become transparent. America or India, see how much sacrifice Indian people gave to build a democracy, correct? The Americans spent $20 trillion to build a democratic Iraq. Still, they couldn't achieve that, correct? So it's a very different way, very difficult way. Indian companies are much more transparent than the Chinese companies. Much more, way ahead than this. So I'm not sure that nobody is going to invest in Chinese digital currency or anything. Somebody cheats you in China, can you sue them? But if somebody cheats you in America, you can take legal actions against them. There is no way you can take any legal action there. Okay, next question is, what is the cheapest way to invest outside India? Most ETFs in India for US indexes have high internal costs. Okay, so there are multiple ways you can invest in US stocks. It depends on what kind of investor you are. So if you are investing, you are building a portfolio and starting, then the best way to invest is to US is buying a mutual fund, which are available in India. There are different kinds of US equity funds available. Now, if you are investing more than ₹1 crore, then you can buy, and you're a sophisticated investor and you know things, then you can open a brokerage account with a US licensed broker in US and invest directly. RBI allows you to do that, and then you get all kinds of ETFs there. But the danger there is that you will speculate, and because that will allow you to buy anything, right from bitcoins to any stocks and this. And unless you're a mature and a very stable and a professional investor, first you need to go through a learning curve of how to invest globally, and I would play safe to invest through mutual funds and then go one by one step ahead. Today, there are multiple ways of investing. Mhm. You can also buy some ETFs available in India on NSE stock market. Uh, what are the tax liabilities in India and US on capital gains earned on investments made in US? Capital gains in India, I'm talking on this, since this event is only for Indian residents, I'm going to answer that question from only from Indian residents' point of view. Uh, Indian resident, when he invests in US, he is liable to pay taxes only in India. Now, if you're investing in mutual fund, then long-term capital gain is after 2 years. Before 2 years, if you sell that, it's a short-term capital gain. Now, if you invest directly in US, again the long-term capital gains after 2 years. Then over less than 2 years is short-term. And when you're investing directly in US, you're considered as FFI, and you don't pay any taxes in US. Only dividend withholding taxes deducted from dividends on your portfolios in US. The rest, everything you pay in India, and you don't have to file any tax returns. Is the diversification allocation expected to be managed uh, dynamically with frequent reallocations to monitor and correct timing? Yes, but again, dynamically means what? When you're building a portfolio, rebalancing happens only once a year or once in 2 years. You don't rebalance your portfolio every week or every 15 days. Or so when you're building a long-term portfolio, uh, the rebalancing should happen over a period of time after an event happens, not every day, not every one. You read a news report and one somebody says this is going to go down, this is going to go up, and you shuffle your portfolio. No, not that way. Mm, eh, Rebalancing happens only over a period of time after you have a sufficient amount. So if your target is to build 2 crores portfolio and you have invested only 20 lakhs, I won't do rebalancing. But if your target to build 2 crores portfolio and you have invested 1.5 crores or 1 crore, yes, rebalancing will happen. So it's everything is relative on case to case basis. Yeah. Mhm. Okay, this is a good question. Has S&P and Dow corrected according to stimulus, or there is still scope? So let me explain you what happened in the market, correct? In the month of February, when this coronavirus impacts started happening, nobody in the world could estimate how much hit on the GDP is going to happen. So the world GDP is of $100 trillion, and the world stock market valuation also was $100 trillion at that time. So for $100 trillion of GDP, $100 trillion of global stock market. Now what happened is when this economy started shutting down, and this event happened for the first time in the world history, nobody knew how much GDP is going to get affected. Is it going to be $5 trillion, $10 trillion, $20 trillion? Nobody knew. So the market took the worst case scenario, and it assumed that it's going to be 30 to 35 trillion dollars. So the market crashed 35% or 40% in a span of just 3 weeks. That was the steepest fall in the history of the world stock market. When it came down by 35% down, and the stimulus money started coming in the market, mm, slowly they started feeling that okay, $100 trillion economy is going to be $90 trillion economy in the 2020, or $85 trillion. So hit is only of $15 trillion, but the market cap has gone down by $40 trillion. So that's why again, when the rough estimates started coming up, the market went up and recovered those balance points. Now going forward, as we go into the next quarter, again I'm saying the market is going to assess. Still nobody knows how long this coronavirus is going to impact. So, and how much damage it's going to do. Still nobody knows. But the rough estimate is going to affect the world economy between 20 to 15 to 20 trillion dollars. So market cap of the world stock market should be $80 trillion. And if you divide it by 50% of is that of US, the US market cap should be around 35 to 40 trillion dollars. Now, again, in that sector, some companies like airlines in short term are getting affected 100%. Cruise industry is getting affected 100%. Banking is not getting affected. Their business is growing, but they are going to have NPAs. So they are getting affected by only 3 or 4%. Now, healthcare is growing, pharma is growing, technology is growing, so their market cap is going up. So it's case to case, sector to sector, the assessment is happening, and rebalancing of portfolio is happening, and reevaluation of the portfolio is happening. Now, some of the stocks, like automobile stocks, nobody knows what is their true value, which is going to come. Now, they have been hammered very badly, like market cap of Tata Motors is only $2 billion today. Just $2 billion, whereas the market cap of Tesla is, sorry, uh, let me, a market cap of Tesla is about $50 billion. So that rebalancing is going to happen. And what you need to do is, instead of picking up on stocks or picking up this, you need to assess the sectors where you want to invest for next 10 years and work out a strategy and build the portfolio that way. And that's what we are doing at Simplicity. We are not focusing on what is going to happen next 3 months or 2 months. We are building the strategy, and for deploying the money, we are using the short-term strategy, but not for short-term trading or making quick bucks. How much time it will take? Sorry, you suggested US and Japan equity in mutual fund, your portfolio. Why only these two countries? Why not Germany? Okay, good question. Okay, still German companies stocks are not available in India. No German ETFs are available in India. Now, we do get German exposure through a US equity mutual fund, small. Now, in Germany, they are only Germany is known for automobile and SAP, correct? And BASF, another very good chemical company. As things mature over a period of next 3 or 4 years, we'll start getting those kind of things, and then we'll evaluate step by step. Good question, but very good question. Why we have chosen Japan? Because Japan, after US dollars, Japan has the best currency in the world today. The best, and Japanese companies are most globalized. Japanese companies are going to benefit. Their 50% business is outside Japan. So they are going to benefit a lot. How much time it will take by the world to make up such a huge loss in the world economy? Okay, it will take minimum 2 years. So for next 2 years, we are going to see the pain of coronavirus. So, like, when you got a heart attack, you ask the doctor, how much time I'm going to take to recover? So doctor will tell you 3 months, 6 months, correct? Your normal life after you do a bypass. So same way, it was a major shock, heart attack to the world economy, and it will take 2 years because even if you have to give vaccination to 8 billion people, it's going to take 2 years to even know that vaccination works, and people are going to be scared to travel. So there's certain industry, and we'll have to adjust our life. Then most of the companies' balance sheets and have got impacted. So everyone will have to do a lot of cleaning work. And so today there is a news item. TCS has declared for next 2 years, 75% of the people will work from home. Why 2 years? Because they are estimating that till 2 years we are not going to get a complete cure of coronavirus. So why take a risk? And why don't we work out our entire business plan with the worst case scenario? And that's what they are doing. So we need to build a portfolio from that perspective. Very good question though. Shall we start investing in manufacturing companies having bases in India, as most companies will move their manufacturing bases to India? Yes and no. Very small exposure through mutual funds, not heavy. Not every manufacturing company is going to come to India. There'll be a very selective where specialization is there. So companies like Siemens, Cummins, international manufacturing companies, yes, they will survive and they'll do well in India. Honeywell, Johnson Controls, Blue Star, quite a few companies. But you should not have a very large exposure, and that through exposure you should take through mutual funds. Yes, but we'll see over a period of time. So far, none of the companies have. We have officially come to know that these companies are going to expand their capacities in India. Uh, we'll see that news coming in next 3 to 6 months time. Hmm. Has the bottom already been formed for India and US? Uh, yes, the medium term bottom has been formed. Now, yes, the February, March 15 was the bottom. We may not revisit that at least for another 8 to 9 months. Now, the next phase of volatility will come. I don't know what's going to happen uh, after the month of November and December when there are going to be US elections. But having said that, correct, there are multiple factors. I don't want to be negative, and at the same time, I don't want we have to be realistic. So very good question. Okay, so let's ask ourselves questions. What kind of personality is able to build wealth and build companies? So I've been pondering, only those who are optimistic, they can build big companies. So imagine if Tata was a pessimistic guy, he could have never built TCS. He could have never built the companies like that, correct? So to build big institutions, you have to be optimist. Imagine if Columbus was a pessimistic, he could have never discovered America. If you, he says, why, let me enjoy my life with my wife and kids. Who the hell cares? I don't want to die. Tata said, my grandfather told me once, Rashmi, I take a government job and be happy. I said, I'll die if I take a government job. There's no life. Life is meant for experience. And, everybody survives. I don't want to live like an animal and just look for myself. I'm going to venture the world, experiment, and build institutions. So only an optimistic person can build a portfolio. Pessimism, if you're pessimistic, you can't build anything because you're always scared. So one of the fundamental things of investing is, when I work with the clients, I try to make them optimistic. I work with them to think positive. The world is not going to end. We are all going to live. The whole world is not going to collapse. So don't try to do bottom fishing. Identify good companies, identify good this thing. So if world was going to end, okay, if market is going to go down next year and next 2 years, why send your children to schools? We still send our children to schools, correct? If the world is, so you have to have a positive attitude. How many times you think, okay, I'm not going to spend money on my kids. Who knows at that time whether they'll get job or not? Why spend money on that? No, we don't think that way. We stand it very optimistic. We are emotionally attached. We want our kids to have a good life. So things will figure it out. Same thing you work with investments. Work out a strategy, work out a vision, and work. So at least for 2020, market may not see the bottom, what we saw that. Next year, I don't know. I'll go with the case. But as time moves on, you work with a professional and insulate your portfolio from all this kind of stuff. And that's an art and science. Yeah. Is it good time to invest in airlines? No, I wouldn't. Airlines where? In India? I don't know. Because in India, there's no government support, correct? In US, yes. Instead of that, I would buy Boeing stock. You invest in airlines, companies which are supporting airlines, correct? Who are supplying parts and equipments to airlines. Yeah, it's that way. But I wouldn't buy those stocks. I would go through a mutual fund route. Tax liabilities for earning from global investments for OCIs residing in India. Yeah, in that case, you are affected by double taxation. You have to pay tax in India and you have to pay differential tax in your original tax country. So whichever country's nationality you are holding, You have to file a tax return there, and you have to file a tax return in India. So Indian government will take the Indian tax, and the difference you will pay in the other country. Uh, and one more final question I'm taking: should we invest by shorting non-essentials stocks? No. Uh, okay, don't challenge the stock market. Our job is to build wealth. Our job is not to play the stock market. You know, a stock market is like an ocean, and why play with the ocean? Correct? Why not ride in the ocean? Why try to challenge the ocean? Shorting means you're challenging the ocean. You think you know more than what the markets knows. No, I wouldn't do that. I would rather focus on my job and build a portfolio of good companies and stay invested. It's very fancy to talk on television. Oh, I knew this and I shorted that stock and I knew that. Uh, no, I wouldn't play to that. We are no, 99% people lose money there. Uh, no, I wouldn't do that. Yeah, thank you very much, and thank you for your time, and I hope you uh, enjoyed today's talk, and look forward to see you next week. Thank you very much. Have a nice day.